Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, my name is Lukasz de Pourbaix, Head of Strategic Sales and Solutions at Fidelity, and I'm joined by Co-Portfolio Manager for our Australian Equities Fund, Sam Heithersay, and Associate Director for Sustainable Investing, Stubbs. And today we're going to be unpacking a little bit around AI, which has obviously been a very topical theme. And this one's going to be really interesting because a lot of the news we hear around AI is very, very much at the top-down level, whereas I think where the interesting point with this one is you guys have had over 31 meetings with boards of ASX listed companies, which is a very unique perspective to provide to our listeners, and really diving in deeply in terms of how they are navigating AI, how prepared are their companies, and where the opportunities and risks sit. So with that, welcome Sam and Sulin.
Thanks, Lucas.
Thanks for having us.
So one of the interesting things we observed late last year was a big sell-off of a lot of the software companies, and it was deemed in a number of terms. One is, which I'm going to get this wrong, it was SaaSacopalypse. I think that was one of them. Anyway, you've probably got your own terms, but effectively we saw a big sell-off of the software companies out globally. But one of the interesting things is that ASX, the Aussie market, actually sold off a lot more than the US market, which is sort of counterintuitive if you think about the tech exposure within Australia versus the US. So interested in your observations as to why that occurred and some observations around that sell-off.
Sure. Well, I think you're right in characterising the SaaSapocalypse as fairly severe in the way it played out in the Australian market and fairly indiscriminate. And I think it's important to assess what happened today because we are seeing a bit of a fight back from some of these SaaS names, particularly in the US. The index there has been up 15% in the last 5 days. But people are also questioning the return on investment from a lot of this AI spend as well. So it's a really important time to assess where we've been in order to assess where we can go from here and whether we should be buying here. You're right in that it was quite severe and indiscriminate in the sell-off. To put some numbers around that, we saw the ASX 200 derate from September to March from 20 to 17 times. That was more than any other developed market. And it was really led by the tech sector, which had a derating of almost halving from 100 times PE to 50 times PE. Now, you could attribute some of that to a pivot in the RBA expectations from cutting to hiking. You could argue that Australia has more AI losers than winners or the hyperscalers. But the general premise was that AI native startups were going to disrupt the business models of software businesses. And if they didn't kill the software business, they would replace the software coder on which a lot of these per-seat revenue model-driven businesses rely. But we saw such a severe sell-off that it raised a few red flags and didn't make a lot of sense to us from a more bottom-up fundamentals perspective. You're right in that we don't have enough tech here, compared to offshore indices that fared a lot better. It's only 5%, whereas it's 35% in the States. We're also lagging the fight back as we speak today. We also have more, obviously, materials and financials that dominate our index, and they are much more insulated from these kind of AI disruption. And something that Sulin found as well was this level of trust and adoption in Australia also seems to lag some developed markets.
Definitely, Sam. I think when you look at kind of international surveys of AI uptake, whether it's trust and kind of adoption and implementation, we can see that Australia actually ranks quite low from a relative sense across different markets internationally. Of course, many OECD markets are quite low on that kind of trust and implementation state versus many developed markets, but still Australia has ranked quite low versus other countries. And I think that was reflected in many of the conversations we had with boards where there was a bit of conservatism, there was a bit of anticipation of how do we implement this, how fast do we go, what does this mean for our workforces. I think that debate has shifted a little bit. They're a little bit more open. They're a little bit ready to implement and kind of really use it across the business and what it means from a value creation perspective. But I think overall, we're still seeing hesitation and we're still seeing a very conservative approach from most boards across Australia.
And so that sell-off, I mean, just if we unpack a little bit more, why do you think it was so brutal from an Australian perspective?
I think there are a number of reasons, and some more perception than reality. I think that it didn't help we had an RBA pivoted around the same time as the sell-off happened. But there was also a perception more broadly that we have more AI losers than winners. This was very much on the assumption that the winners were a very narrow group of winners. They were the hyperscalers or the frontier model pioneers. And Australia, to be fair, does not have many of those. But I think if we were to look at AI disruption from a longer term perspective, the second phase of AI is much more about diffusion and adoption. And from that perspective, we have a number of companies that potentially benefit from AI. And the market wasn't really pricing that in this largely indiscriminate sell-off. So for all those reasons, and for the point that Sue Lin made on that trust and adoption was already lagging, it didn't quite add up from our perspective why we saw such an indiscriminate sell-off into March. And that prompted a lot of work on our behalf to really deploy our bottom-up fundamental research to try and identify the winners and losers.
And when we think about from a governance perspective, and Sue Lin, you've published a paper called Governing in the Age of AI, which I encourage our listeners to look up because it's a very insightful article, leveraging a lot of the insight from the boards. I guess your sort of initial observations from a governance perspective and where companies are in terms of their AI journey, what were some of your high-level observations?
Yeah, I think overall we did identify that there is a bit of a gap in terms of implementation, but then from a governance and kind of risk management perspective. And I think when we spoke to many of the boards, where they're at is really from that efficiency and cost implementation and productivity perspective, less from a revenue and kind of customer generation perspective and that value creation piece. So I think overall we're kind of seeing a bifurcation of how some CEOs are talking about implementing AI and really driving revenue growth versus how boards are kind of describing it more conservative, very much from that efficiency and productivity perspective. So I think that was one kind of aspect that was highlighted across all our conversations with boards. I think the other piece that was, also talked to was around what stage they're at. What are they looking at kind of pilot initiatives? Are they looking at implementing this across their organization? And what would the business model implications be of implementing AI more holistically across the business?
And so if you think about the access you have, it is a quite unique position, having that on-the-ground access. Obviously, from a Fidelity perspective, that is one of the key, edges of Fidelity's having that waterfront access. When you had those meetings, what was did anything surprise you in terms of those meetings and any sort of unique observations you had?
I think overall, some of the things that surprised us was really around the level of implementation versus kind of the governance risk models, particularly when we think about risk. When we spoke to some of the companies, all of them said that they were implementing it into their enterprise risk models, for example, and they weren't having a separate kind of AI risk framework. And I think overall, we all are aware that AI really amplifies existing risks. And so it was something that caught our attention and we were focusing on, and I think we'll continue to engage with many of our companies and boards on, is how they're thinking about AI risk, what is the perception risk here, and how are they managing that risk going forward. And I think the other key piece is also around shadow AI. It kind of gets thrown around a lot as a term, but it's really around how employees are using their own AI devices and using it on their phones or personal devices, et cetera. And so what does that mean from an IP risk perspective, leakage, whether there could be reputational or litigation issues later from a business model perspective. So again, that was another key risk that we identified, but not many boards are talking about. And so I think this could potentially be an area of AI risk that has been overlooked.
And Sam, from a bottom-up perspective, a stock perspective, I mean, having these type of insights, these type of discussions, how's it framed your thinking in terms of when you're looking at a company, and one of the things you may be looking at is how they are navigating AI. What has this sort of exercise highlighted for you?
Well, it was crucial drawing on Sue Lin's work to really frame the entire ASX 200 against a framework of 11 characteristics that we defined as to whether they may be AI winners or losers. Because we thought from that base we would be able to assess where opportunities, where mispricing might arise and where we should be holding for the longer term. So we leveraged a lot of the work that Sue Lin did to formulate this framework, and then every analyst who covered their own stocks and sectors deployed that framework, knew their companies very well, and ultimately came up with a score which we could set against the underperformance to work out if something wasn't quite right. The framework really centered around a number of different factors, but digital vulnerability, one of them, task commoditization, as well as focusing on moats, so protection against an AI native startup, whether it's regulatory, proprietary data, integration and customer workflow. And it's important to overlay that with the risk that these proprietary data moats or these regulatory moats may unwind because, as Sulin highlights, we're still very early days in the way that some of these companies assess their risk and the AI risk and how it's integrated into their risk management policies. So that proprietary data moat could very well disappear if there is a cyber attack, AI enabled. So it's important to marry the two, but we essentially came up with a bottom-up framework to assess each of companies and assess whether there was a mispricing, and from that came out with a set of winners and losers that we thought we could invest in.
So if we think about that AI theme, it is evolving at a rapid pace. So trying to separate winners from losers can be challenging. Have you got any sort of past examples of winners and losers that our listeners can sort of anchor to when they're thinking about this theme?
Well, I think it's important to highlight the difference between a winner or a loser as it stands today and how the company may be able to adapt in future to this disruptive technology. What was really instructive for us was to look back on previous examples of disruptive technologies, and we have the research and the history to be able to do that. And we realised that when you look at disruptive technologies like AI, it's often the companies that are able to pivot and adapt, not just defend their own competitive moats, that really do thrive and make better long-term investments. So, for example, Kodak and Fujifilm in the early 90s, when digital photography came along, Kodak was unwilling to cannibalise their own print photography business. Fujifilm was much more willing to pivot, and they did, into healthcare and survived as a result. Now, if you were to come with a framework in 1993 and assess each of those companies, you'd probably come out with a similar risk profile. So it really came down to who could pivot and who could adapt in front of this and get ahead of this disruptive technology. And so when we're looking at winners and losers, we're much more focused on the winners that we think can adapt to this change. And the best read we have on who can adapt and who can't is this litmus test of the governance of AI. It's really just gives us a great insight into how mature a company may be in their thinking around AI, because those companies are more likely to be able to adapt and pivot and make ultimately better longer-term investments.
Yeah, 100%. I think, governance can really act as an early signal of which companies have the right culture to lean into AI implementation, have the right risk and governance structures to really manage any amplified risk from AI, and also just to really have that strong focus from a strategic value creation perspective. We have heard from some companies, 100 plus AI options, a 300-page deck of all our AI projects that we have out there. And I think from an investor point of view, that actually raises more concerns around investment, CapEx, and whether there will be a return on that AI investment and what we're focused on. So I think it's a great early indicator that we'll continue to improve on, get additional metrics, have more conversations with companies and boards that we have access to as Fidelity, and really be able to better measure who can be adaptable, who can be not disruptive, but actually change and pivot their business model to be more AI native.
And just further to that, if we think about some of the risks, because it's a very exciting part of the market. Obviously, anything linked with AI has done generally pretty well in terms of performance. But then there's the other side of the equation. It is the risk, and given that it is very fast paced and evolving, what do you think are some of the risks that we should be aware of, and some of the risks that are emerging?
Yeah, definitely. I think the first one, we've said it before, but I think AI really amplifies existing risk. And that's really telling with certain cases that we've seen in the press already. And, you hear about AI washing and what does that mean for different companies? And is it really value creation or is it just a headline? I think some of the key red flags that we've seen is one around the CEO board disconnect on the AI narrative, where the CEO is very bullish and the board is far more conservative. Our concern there is on strategic value alignment, and then also how much investment is going into these projects and how much value is really being generated from the investment spend. It's it's really interesting. We actually spoke to one tech company recently, and they shared that they're now having more board packs with AI metrics involved and getting more granular. And so previously they were looking at like revenue per FTE, but now they're looking at revenue plus CapEx per FTE to really understand token usage and what does that mean across their organization. So really getting more granular to understand the investment implications of AI. The other one, which was a bit surprising, was many boards couldn't really articulate no-go areas. We were very concerned where they couldn't really articulate if there was a risk, for example, whether it was like customer bias or workforce surveillance, those types of things. Many boards couldn't really share where they had put lines in the sands where they wouldn't use AI or where they wouldn't implement AI. And then I think the final thing, which I think Sam and I were a bit surprised on, was on workforce disruption. Most of our boards were saying in the next 12 to 24 months, the workforce shape wouldn't change. There wouldn't be many layoffs. They were very conservative. But I think the headlines have been quite different. And some of your conversations, Sam, have been different as well.
Yeah, that's right. I think there's perhaps some overinflated forecasts of the potential redundancies that we may see as a result of AI, and a lot of them are offered by those that stand to gain the most in AI startups, but they certainly contributed to that indiscriminate sell-off that we were discussing earlier. What we recognise when we speak to companies directly about this point is that there is a level of investment that is required before they can realise the efficiencies on the other side of AI. And it's what we would term the J-curve effect, where essentially you have to invest in the foundational data sets, in the teams themselves, in retraining yourself, as we've all done with prompt engineering, as we've moved away from standard search engines to more AI-focused tools. All of this is naturally inefficient to begin with before you recognise those efficiencies on the other side. And to play that out at an aggregate level, at a company level, it is often the case that companies will say they are investing in AI and sometimes have to hire ahead of that before they necessarily realise the operational efficiencies that would result in a lower headcount on the other side. So I think it will take probably longer than some of those forecasts are certainly predicting. And it's also the case that we're much better at forecasting the jobs that are lost more than the jobs that are created when a general disruptive technology like this comes along. And so I'm naturally fairly sceptical when it comes to these projections of AI-led redundancies. And that's important for our investment universe because, of course, if it were to come to pass, it would have significant ramifications for the ASX 200. I just think it'll be slower, and the J-curve will mean that we might see some investment before we see some efficiencies.
Yeah, actually, just coming back to the J-curve, we were speaking to one global financial platform, the chair of this global financial platform, and he was describing how while they're seeing efficiencies and productivity from their AI investment, they actually have to run dual platforms because they have customers who are very AI aware and actually don't want to be using AI. So they actually have to run a traditional platform and then an AI-enabled platform. And so in the interim, the costs have actually gone up, right? And so you're not actually seeing that investment come through and the cost savings come through. And so like Sam said, it will be a J-curve. I think it will be a bit bumpy and lumpy to begin with, but then we will see that acceleration where people become more comfortable, they trust the technology, and then you can actually start to see the savings. But for now, it is a little bit more opaque, and we're not getting clear answer from boards on what that investment return is from AI implementation.
Which is an important question to ask, and investors are obviously asking right now. And the more advanced companies that we speak to will have this nuance in their answer around balancing the cost of tokens with the efficiency gains from a redundant headcount. That's only just started to enter the conversation recently, but when we were conducting a lot of this survey work last year, it was very much all about investment upfront, a lot more tech spend, and considerations around weighing up headcount alongside token cost was not really in the realm of consideration at that point, but I'm sure it will, and we're likely to see it more so in those companies that we consider to be AI mature.
And so if we sort of look to wrap things up, for investors out there that are trying to work out what the lay of the land will be with this theme and which companies will maybe benefit and others maybe not, interested in your sort of initial sort of thoughts, what would your key sort of guidance be for investors in terms of their top couple of things to think about when they're thinking about this theme and how they approach it from an investment perspective?
Yeah, I think that for us, it's incredibly important to stay very close to companies and be very close to management, because ultimately, as I said, that I think the long-term winners from this general disruptive technology will be those that can adapt and pivot. All companies, will have the rhetoric around AI that reads very well and is no doubt AI generated itself. So it's very hard to pierce that rhetoric around their AI adoption unless you put management alongside another management team and start comparing and contrasting company and management and board approaches to work out who can adapt and pivot sufficiently ahead of this technology. So for me, it's all about staying very close to companies to work out the longer term winners are going to be those who can adapt and pivot. And it's not very apparent right now who that will be. We have to conduct this survey work over a number of different time periods to understand how it evolves. But we think we've got a bit of an understanding about who's leading the race right now, and on that basis, we're comfortable with investing.
And I think right now, the truth is the data isn't out there, right? We can't use a proxy. We can't just look at certain data providers and try to assess that risk. We actually have to have these one-on-one meetings with boards and companies to really understand how they're thinking about it. What are they implementing? What are their risk profiles, et cetera? So I think it's very much what Sam said. I echo his thoughts on we have to stay close to this. We have to measure development and improvement through time, and also really be able to track how our boards are thinking about it, how management teams are thinking about it, and be able to kind of read through the headlines, the presentations, and really dig deep on what do they actually mean when they've said this new AI project or this new strategic value creation piece. And so that's very much one of what we're going to be focused on in the second half and going forward, and what we'll be staying close to boards and management teams as well.
Well, Sulin and Sam, thank you very much for your time. I think that's been a fascinating discussion and a very interesting take on the whole AI theme. And to me, it sort of highlights the importance of having that bottom-up research, being very close to the companies, and having the access that we have is quite incredible. So to be able to have that and gain those insights is, I think, a real advantage. And for those listeners that are interested, as I mentioned before, there is a paper on the Fidelity website, fidelity.com.au, called Governing in the Age of AI. If you'd like to find out more, please access that. Thanks again.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only, has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.